Hello, my name is Brian Overby. I am the author of the Options Playbook, and welcome to Options Guy TV. Well, we start off every week talking a little bit about one particular strategy. Last week, we looked at long calls. This week, we're going to look at short call spreads or short spreads in general. We have the earnings week is winding down. We have about 1,000 companies left, but a lot of the major large cap stocks have announced already. But I still want to keep the earnings thing going. So there are one company that I always like to look at around earnings is Skyworks. Skyworks is a company that makes chips and processors for a lot of Apple products. They have issues in that their main client is Apple, and if they lose Apple, they basically lose their business. So if we look at the markets today, we're a little bit mixed. Looked like on the open we were going to be positive across all aspects, but we have the Russell 2000 down just a fraction. The NASDAQ is up a fraction. Dow, I guess the Dow is the strongest of the major, well, the indexes that we like to quote. I don't like to say the Dow is really a major index because it only covers a few stocks. But we're looking up about 1% on that. And we have the VIX trading higher. And I think that's ahead of the inflation report. We obviously last week, I think the markets are still trying to figure out exactly how to digest the downgrade in the U.S. debt that came out last week. It made the markets drop, but then they rallied back. So not really sure how to take that. And I think that's part of the reason why we see the VIX. We have some important economic data coming out this week. And on top of it, you have the news from last week that I think is still a little bit of a hangover in the VIX index. So with that said, we're going to once again, we're going to have a theme. Our theme is going to be short spreads. And we're going to look at two short call spreads today. One's going to be pure speculation on a stock that's going to announce earnings. Don't always like to do short spreads in general around a stock that's going to announce earnings just because the risk reward is always different. You're selling an out of the money spread, bringing in a smaller credit where you have a lot more risk. So in that instance, if you're doing that trade, the risk reward doesn't always look great, but the probability of success is fairly high. Downside of an earnings report is the gap opening, or if it could gap way up or gap way down more than the expected move. So it's obviously speculative to do these type of spreads around earnings. But once again, that's our theme. I want to talk a little bit about if you're doing the spread, how we would set that spread up. And then we're going to look at a longer term spread. And to kind of keep with our theme, I guess we're going to stay in the SPY index, and we're going to go out further in time. And we're going to look at a traditional trade that somebody might do month in and month out in the SPY index. And we're going to go out farther dated in time, and we're just going to sell a good old credit spread going out about 45 days in the SPY index. So let's start with Skyworks. All right. So if I look at Skyworks, if I'm ever going to do almost any type of trade around earnings, the first thing I want to know is what is the marketplace telling me about that earnings? So we see Skyworks right now right at 110. So the most at the money option contract inside the Trade Hawk software is going to be that 110 strike. We have the ask on this column and the bid on this column. So I want to know what is the long straddle trading for. And in the public space, that's often referred to as the expected move. So if we look at the 110 strike, we buy on the ask, buy on the bid, we're right around $6.50. That means that in Skyworks, we're looking at an expected move right around 6%, which actually the implied volatilities kind of came off on Skyworks. So usually around earnings, they used to have IV right up around 100%. A little bit lower. Also, Apple was a little bit lower. The expected move on Apple was only about 3%. And we actually had kind of a muted move in Apple after earnings. Today, we actually see Apple down even more. And I'm going to highlight it as I see it going across my screen. And Apple is actually down almost that 3% right now, down 2.3%. So we're going to get neutral to bearish on Skyworks going into their earnings report. Skyworks is always interesting. Apple, I think, usually has a tendency to sell off going into earnings, more so than we see the big rallies, unless there's a huge surprise in Apple, especially when the stock has had a strong run up like it's had since the beginning of the year, even going back a year in time. Apple has had a really strong move. So a lot of times they'll take that opportunity around earnings, the marketplace, and sell off a stock that's made a real strong move on that. Skyworks is a little different, though. If I look at the chart of Skyworks, it's definitely not had that strong move that Apple has had. This is going out 800 days in time. So let's go back to the beginning of 2023. We had a fairly decent move up, and then we've all given it almost all back, going out. This looks like May, about the middle of May. And now we're trying to make a little bit more of a strong move to the upside. We do have the 200-day. We had the 50-day crossover, kind of helped out a little bit, but then the 20-day came back down. So we're just really in this area of limbo. Now, right around this area right here is the 118 level. Obviously, this high is of interest. I would like to sell something above that 124 area, and that would be great, because on the chart that looks like a nice solid area of resistance. It would really, if Skyworks actually broke through that level, I might want to change my focus and actually get long. But if I look to sell that on a short-term basis, I'm just not getting enough premium. It's that simple, right around that 124 strike. Because as we mentioned, $6, I look at my notes over here, $6.50 is the expected move with the stock at 110. We're looking at a 116.50 strike around the expected move. And remember, the one standard deviation move is always a little bit more than that, and we'd like to get out at least that far in time. So let's go back to the chains and let's look how we're going to set this trade up. Okay. I looked at the different expirations, and I would consider going out 11 days in time or so, and you could potentially adjust it. But I decided that I'm just going to do the shortest expiration. I'm going to do 4 days. I'm going to look at the August 11th expiration. And part of the reason why is that I'm getting that increase implied volatility. There's a big drop off in implied volatility between the August 11th expiration and the August 18th expiration. And because of that, and I don't know if I'm going to get that much time to adjust, I decided not to do the 118, because the biggest reason why I would go up further in time on a short spread is that if the market goes against you, that increased premium will allow you to adjust the trade. And I don't really feel like we're going to have much chance to adjust this trade after earnings. We go up 4 days. You still got a few more days in there to the end of the week. They're announcing after the close tonight, 18th, and then I don't want to go out to September. I don't want to be in this trade this long, okay? And on top of it, we're going to do a more a less risky, less speculative trade in the SPY. So let's have our trade around our earnings, and it's going to be that short spread in Skyworks. So how would we set this up? Well, the expected move, if we were to just buy the long straddle, or I guess you could sell it. Doesn't really matter what vernacular you want to use. You just want to know what the marketplace is anticipating a move may be after earnings. And I'm going to emphasize this. We're using the August 11th option contracts. So this is the move going into Friday. It's not just after earnings. And if we look at that, we see that this is trading at 340. We'll call this one 320. And so I rounded off to about 650 using kind of the midpoints on this. 6% move, 116 strikes. So between 116 and 117 is the expected move. And the TradeHawk software highlights a one standard deviation move. So we're shadowing right around 119 would be a one standard deviation move. But as you see on my chain, I have highlighted, one second here, jumped on me. I have highlighted the 118 and the 121 strike. So we're going to go 3 points wide. I considered going 2 points wide, but I wasn't bringing in quite enough of a credit in order to do that. So I widened it a little bit, which I'm not too happy about. It means I got to take an extra $100 worth of risk on my 1-by-1 spread. But then I got a limit price that I can live with. Right now, the midpoint is 35 cents. Around earnings, I would hope that I could fill somewhere close to that midpoint, but we're going to end up selling the 118 strike call, and that is our speculation. That brings in our risk. And to protect ourselves, we're going to go out and buy the 121 strike call, and that stops the pain. The 121 is obviously trading for less than the 118. You do the net credits to the account, the difference between the 118 and the 121, and we get a midpoint price right around 35 cents. So I don't really anticipate that there's going to be much to adjust, but if the stock would open up right at 118, I'd probably just close it and get out. On the open, there's still going to probably be a little bit of volatility left, and we do have 4 days to that expiration, so you would have a chance to just close it and try to minimize your risk. But if we do a 3-point wide spread and you subtract the 35 cents that we hope to bring in if we filled at the midpoint, your total risk is going to be $2.65 on that trade. So the probability of success is fairly high on this, because what you're hoping that the market doesn't open more than the expected move. That would be ideal. The ideal would be that it would actually open down the expected move, right, to the downside. But if it does open up, we don't want it to open up more than the expected move, and we definitely don't want it to open up more than one standard deviation move. So we've set up our spread where we're getting an okay credit based off of what the marketplace is implying the move might be. Now, it's earnings. After earnings tonight, on a company like Skyworks, anything could happen. You can have a gap opening, of course, which would not allow you to do anything on that trade. But if I'm doing this trade, I'm probably not going to adjust it. I'm putting it on. I'm hoping that I can get out tomorrow at a 35 cent, get as much of that credit as possible. If I can close it out for a nickel, I'm going to do it. I'm not going to hang around and try to get that last 5 cents on that underlying. And I'm going to close that out as soon as possible, and I'll move on to my next trade. And that's simple. So this is the official paper trade for Monday, August 7th, Option Guide TV. This will be the official paper trade. Now, on top of it, we always like to put in that disclaimer that if I'm put in the disclaimer that this is not meant to be a recommendation. We're just trying to learn here. And that's part of the reason why we're going to look at 2 spreads, because we're going to take a totally different approach and look at a longer term short call spread on a less speculative underlying. Now, with that said, if you have any questions that you would like, we like this to be a very interactive show here on Options Guy TV. So if you do have any questions, please feel free to put them in the chat box, and we'll try to address them on any trade that we're talking about. I like to keep it on topic a little bit if we can, but on any trade that we're talking about here on Options Guy TV, please feel free to put in a comment and I'll try to address them. All right, so now let's look at a trade in the SPY. All right, so on Friday's Options Guy TV, we talked a little bit about the seasonality. We're in August, the beginning of August, obviously, August 7th. And September and October are usually volatile months. Actually, September is one of the worst performing months in the markets going back 20 plus years. But that doesn't necessarily mean that the market's going down. Worst performing means like it's basically flat year over year in the month of September. But obviously, there's been a lot more volatility in these months. A lot of the major crashes have happened in September and October. Over the years, nobody knows why. We talked about it. We looked at the seasonality of the VIX. If you look at the VIX index, VIX over time, once again, has usually remained much higher in August, September, and October, as opposed to the beginning of the summer, which is April, May, June, July, right? So that kind of hints to you that, for some reason, these months seem to be a little bit more scary. as far as volatility. And a lot of times people equate volatility to downside, and it's not necessarily the case. But markets do have a tendency to go down at a quicker, faster, more abrupt rate than they do go up. And hence, that's part of the reason why the VIX will stay elevated. Okay, so in the SPY now, we are going to look at a different expiration. We have here the August 11th expiration. If I'm going to do a short call spread, a short put spread, however, whatever direction you want to be, short put spread means you want the market to go up. Short call spread means you want the market to go down. Obviously, if the market just stays where it's at, these are good for these out of the money short spreads. But if I do it, I do like to go out further in time. And I do like to do it on something that's a little bit more stable. My little quip that I like to use is that I'm looking for something that has some volatility with some predictability, right? So it's a little bit of an oxymoron, but that's what I'm looking for. And usually an index or an ETF will kind of provide that. It will mute the volatility a little bit as you go out. It'll mute the volatility a little bit as you go out in time. All right. So looks like I do have one question that popped up. This is on Skyworks. Okay. So before I get into the trade in the SPY, I would like to show this question on Skyworks. Let's see what we have. What would you do if Skyworks opened above the 118 strike, around 120? Would you adjust or close it to minimize the risk? Yeah, I would close it. And I think I emphasized that a little bit, that there isn't too much that we can do if we get that big gap opening above 120, because we're going to have a very short time frame. Implied volatilities are going to come in. So if I can do it quickly, sometimes the implied volatility, the fact that we're on a Monday and these expire on Friday, that can be helpful. So it might minimize your risk a little bit. Obviously, the maximum you could lose on that trade was $2.65. So maybe you get out and only lose $2 as opposed to $2.65. I'll take it, right? If I did get that big gap opening. Now, one of the big benefits, though, on that trade is that if it just opens up even the expected move towards your strikes, right, in the wrong direction for your trade, even if that happens, implied volatility can come off and help out that position quite a bit. As a matter of fact, you may be up on that trade if it only opens the expected move to the upside, because we're at least one standard deviation out. All right. Thank you for the question. SPY. All right. So I'm going to go out 45 days on this one. And so that means there's a lot of different expirations in the SPYs or in the SPX. And the SPY is obviously representative of the SPX. It is the ETF that tracks it. It's probably the most heavily traded underlying stock in the U.S. markets right now. And if we look at the September 22nd expiration, you have 46 days to that expiration date. I like this range. I like being out about 45 days when I'm looking at a short spread in an index or something that is a little less volatile. Part of the reason why is not that I want to hold it for 45 days. I just like on the curve, if we go like from 45 days and say I want to do a 20-day trade, I'm probably going to get out on day 20 of the trade and just close out the position. If the stock kind of stays where it's at, that's fine. I just like the curve in that level. That also allows you the adjustment. I need time premium in my option contracts in order to adjust. Hence, Skyworks is going to be very hard to adjust if it goes against us fast. And the SPY will have plenty of time to adjust it. But I'm still trying to look at this at more like a 20-day or maybe a 25-day trade, as opposed to trying to stay in it for the entire expiration. All right, so if I do it, once again, we're going to try to keep things simple. We're going to look at a one standard deviation move. And once again, the high, if we look at these strikes, all right, it looks like I might have to move a little bit more on the strikes. Let's see where the 149 we're at. So we're looking at about, if I do real quick math here, we'll round this up to 10 and round that down to about 18 points here. So 168 or so is the expected move. So we're going to need a few more strikes I'm going to have to add to this. 1 second here. And then we're going to go and then we'll look at doing that trade going out a little further in time. All right, 1 second. I think I'm going to have to actually do a little bit of work. Let's I'll keep talking a little bit about the trade and the adjustment, and we'll jump up to here. And I'm going to have to actually get my chain to show me a little bit more, a few more. I got to adjust my outlook here and get a few more strikes to be able to get out at least that one standard deviation move. So if I'm going to adjust this trade, what I want to do is if the market starts moving against me, I'm either going to roll up and out in time on that trade, or I can adjust it. And one of the things that I would look to do on that adjustment is either add another spread. I could do it on the opposite side and roll it into a condor, or I can actually make this a positive trade working on my side and maybe roll it into a butterfly trade. And so this strategy that we're going to look at is going to this one's going to work over time. So we're going to come back and we're going to review this trade, and we'll look at exactly how we're going to want to adjust that trade overall. All right. Account view, object grid. I apologize. Just 1 second here. I guess I think I might just run with it, with what we have. I'd like to get a little bit further out in time, but okay. So if I'm looking at this strike, we're going to keep it the same amount of risk. So we're going to look at a 3-point wide strike. So we're going to go from 462 to 465. So on this, in order to set up that spread, we're going to be clicking on the bid, which is 462. And we're going to be then clicking on the ask, which is 465. So we're doing a 3-point wide spread, which that's going to be our maximum risk. And I'm going to keep it 3 points wide just because that's exactly what we were kind of looking at on the Skyworks trade. And then we're going to bring in 91 cents worth of net credit to the account. We'll round it off to 90. I see it at 90 right now. So almost $1 on this trade on a 3-point wide spread. I don't mind that as much. If we were a little bit further out on the actual strikes, we'd be looking at about maybe 50 or 60 cents on a 3-point wide spread. But I'm okay with doing this for 90 cents at this point in time. I guess I'm pivoting a little bit to be blunt on the trade. And if we sell this trade, then now what I want to do is if the market gets halfway to my strike from where it's at right now. So 462 is where we're looking at it, 459. So right around the 455 level, I want to make note of that level. And if the market gets to there, I'm going to think about how I might want to adjust the trade. Now, as we get closer and closer to the strike, if it's still moving against us, well, then we'll take the time to look at an adjustment. We might roll it out. I do not want it to get to the short strike. If it gets to the short strike, well, then to me, we've waited too long to adjust that trade. So this will be the second trade of the week. The official paper trade is going to be on Skyworks, and we'll come back on Wednesday's show, and we'll actually look at that trade. And then in this one, on the 462 to 465 strikes, we'll be looking at maybe doing an adjustment if the market comes against us. Hopefully, we'll have the markets actually open down a little bit on the trade. I got it on for 90 cents. If I can get this off for anywhere around 30 or 25 cents, I'm going to do this. So I'm looking to make not the entire amount like I might be looking for in the Skyworks trade. I'm going to make sure that if I can get the bulk of my credit that I received on the trade, if I can get the bulk of it, I'm going to close it out. So anywhere around 30 cents or 25 cents, I'm just going to take the trade off and I'm going to move on with that. So now, if you have any other questions, I apologize for the confusion a little bit. Let me emphasize. Let's go back and talk a little bit about the trade then. We're at 448.63 on the SPY. So the most at the money strike is the 449 strike. We're going out to the 462 strike. We're going to be selling that option contract and at the same time buying the 465. We have a 3-point wide spread that we're looking to do. We're going to bring in a 90-cent net credit to the account. That means we have $2.10 worth of risk. But on this trade, we're going out 45 days in time. Our expiration date is going to be September, or 46 days to be more accurate. It's going to be a Friday, September 22nd. And if the market does move against us, we're going to look to adjust it. All right. If you have any other questions, that's great. If not, that's going to be it for this edition of Options Guy TV. We will see you this Wednesday for the next edition of Options Guy TV, and we'll see how that Skyworks trade actually works out. So please click subscribe, ring the bell, and pound that thumbs up. That helps us out a lot. And thanks for coming.